Craig Bishop. Let's go around the bond world. We'll start off with investment-grade corporate bonds. Judging from what you've heard during second quarter earnings season so far, is corporate America in good shape? Can they pay those coupons?
Sure, Greg, I think that's a good question. The earnings season has been somewhat erratic, good earnings and some poor earnings, but overall, we're positive on the corporate bond space, especially the investment grade space. Although, at RBC Wealth Management, our focus and our advice to clients has really been to look more toward that BBB rated space as far as the better opportunities. And as part of that, also, it's positioning on the yield curve, focusing on maturities in that 6 to 8 year maturity range. We feel good yield pickup there, curve roll down opportunities, and a steepness of the curve is a great opportunity.
All right, well, speaking of yield, what about high yield? People are worried about that. It's really sold off with stocks recently. Some worried about a liquidity crisis with regard to high yield. What's your view?
Yeah, I mean, high yield, you really have kind of a bifurcated market in high yield right now, energy and non-energy names. And spreads have widened in both spaces, but if you look over just the last week, for example, high yield spreads, ex-energy, leaked wider by about 20 to 30 basis points. High energy-related names widened by about 100 basis points. So, we're at this point in time, we're a little bit cautious on high yield, especially the energy names. We've been selectively focusing on non-energy names, adding them to some of our portfolios that we follow. But overall, it's a market where we think there's going to continue to be more pressure near term, and we'll wait for better opportunities at this point.
Munis, meanwhile, have been flat so far in 2015. Should investors just be happy to clip the coupons on those?
Munis are an interesting story because over the course of this year with low interest rates, there's been a lot of supply driven by refundings, municipalities refunding higher coupon debt. And that's created kind of a supply demand imbalance. And we've seen as interest rates have moved higher since April, that supply, the new supply is lessened a little bit. Investors have picked up the demand, and that's helped to keep muni performance over the course of this year positive. Now, within the muni space, there certainly have been some headline events recently. Puerto Rico, issues with Chicago/Illinois, those are things that we're paying attention to. But if you look at those two credits, or those two areas, they're really less than 3% of the total $3.7 trillion muni market. So overall, we think munis for high tax bracket investors are really some of the better opportunities right now.
And I continue to hear that munis are cheap versus treasuries. Let's talk about treasuries. Right now, the 10-year treasury yield is at 2.3%. Will it end up around there? Because it seems as though we're in a range.
Right. I think our advice to our investors and our advisors recently has been that don't look for a big jump up in interest rates because of what the Fed may or may not do. There's still a lot of speculation going on with what the Fed will do. Maybe we'll get some clarification this afternoon. But you look at the overall economy in the U.S., low growth, slow growth, 2.5%. Low inflation, in our view, and what we're telling our clients at RBC Wealth Management is that we don't expect to see a lot of upward pressure on interest rates. So I think where we are right now, roughly 2.25, 2.40 is probably a good range for the rest of the year.
And then finally, what about foreign bonds on the equity side? Europe and Japan are outperforming U.S. equities. So how should people allocate their assets when it comes to international bonds?
Sure. On the international to, international, are you including emerging markets in that, or are you talking not emerging markets?
Emerging markets and developed markets.
Thank you. So
got to have a little of them all, right?
Yeah, absolutely. So I think, if you separate the two and look at emerging, developed economies, there are some opportunities there that we're paying attention to. We think that, especially in Europe, some of the, with the recovery beginning to take place, it looks like the ECB's QE program is taking hold, that the recovery is taking hold. So we're focused on some of the opportunities there in, investment-grade corporates, intermediate maturities, as places for investors to look at. Emerging market is a different story, however. I think with what we've seen happen recently in China, what's going on, say, in Brazil as well, there's some issues there that we think are going to kind of hurt performance there. And so we're somewhat cautious there. We think that as the Fed begins to raise rates at some point, the dollar is going to continue to strengthen. That's going to hurt some of these emerging market economies. So at this point, we longer term, we think a country, there will be opportunities, but we want to be patient right now.
All right, thanks a lot, Craig.
Greg, my pleasure. Thank you.
Thank you for watching The Street.